Hey all, a very good evening, and thank you all for joining us today. I'm Akshara Menon from Famous Bazaar, and it's my pleasure to welcome you to a highly anticipated webinar on the topic, a role of private credit in portfolio diversification. Private credit has emerged as a key asset class for investors seeking higher returns, reduced correlation with the traditional markets, and increased portfolio diversification. In today's evolving financial landscape, it's become an essential tool for managing risk and accessing unique opportunities that are not available in the public markets. We are thrilled to have Mr. Ahmed Kansal, a seasoned expert with over 22 years of experience in the financial industry. To give you a brief overview of Mr. Kansal's extensive career, he has worked with the prestigious organizations such as Aditya Birla Capital, which is his current organization, ICICI Bank, and EY, among others. He has conceptualized and operationalized and led the special situations stressed asset platform at Aditya Birla Capital, which includes a joint venture with Word Partners, a leading US-based credit fund. Prior to this, Mr. Kansal was at a helm of structured finance vertical for North and East India at Aditya Birla Finance. His experience spans across the entire credit spectrum, from investments in single-digit yield papers in large corporate groups to high RR trades in complex asset reconstruction situations in returns such as high as 70% of per annum. As an alumnus of prestigious Sri Ram College of Commerce, Mr. Kansal is a rank holder chartered accountant. With his expertise in both high-risk structured credit investments, he's one of the best individuals to provide a deep insights into how private credit can be leveraged into portfolio diversification. So without further ado, let's dive into today's session. Mr. Kansal, thank you so much for joining us today. We are excited to hear from your thoughts on the topic. And to the participants, we encourage you to drop the questions on the Q&A box, which will be answered by the speaker towards the end of the session. So over to you, sir.
Good evening, Akshara. Good evening, participants. Thanks for having me on this show. And thank you all for joining in. So let me share my thoughts and I'll use a small PowerPoint presentation to, convey my thoughts. Yeah. Before I delve into the presentation, let me just take a step back and talk about what is private credit, because I'm sure you would have heard this term several times, but different people have different connotations. So I thought I'll just take a minute to spend on what do you really mean by private credit. So private credit is a trade which is not really a custom or a standard trade. See, when you are dealing with public markets, there are set customs, set boundaries, and certain standards with which both the issuer as well as the kind of other market participant are supposed to adhere to. Whereas private credit is a bespoke solution between two entities, and it can take any shape or form. So I think the term private credit draws a lot from being not public, because public markets, there are a lot of people who are kind of buying and selling are supposed to adhere to certain set norms, whereas in private credit, you may have certain complexities which may not be there in public markets. So that's from where the nomenclature private credit has come into the being. So today I'm going to talk about how private credit has grown, both in India as well as globally. What are the kind of opportunities we see, especially in the Indian context? What is the lay of land in terms of different strategies that we have in the private credit, and what is Aditya Birla doing within the same? So if we look at from a global perspective, private credit really took off post the global financial crisis. As you are most probably aware, it was triggered by the collapse of Lehman Brothers, and at the heart of it lied complex transactions, financial transactions, which brought it down. So there was a lot of regulatory tightening, increase in risk weightage, as well as risk aversion on the part of banks and financial institutions. So it left a huge void, which in the global context, or especially in the US context, was filled by private credit. So if you look at the chart, which is there on the left, so private credit has gone around 10x from 2007-8 to around 2.2, $2.3 trillion currently. And as per certain reports, it is projected to grow to 3.5 trillion in the next 3-4 years, which, mind you, in the global context is a phenomenal growth rate, because globally we don't see those kind of growth rates. So even if we look at on a larger base of last 7-8 years, it is still growing at a CAGR of 18%. And if you look from an Indian context, I think the mirror of Lehman moment in Indian context was 2018, when your IL&FS crisis happened, when your Yes Bank collapse happened, and when your DHFL happened. I think that was the GFC movement for India, and private credit really started taking shape after that. So in terms of deal flow, if you look at private credit was just around $2.4 billion in 2018, whereas as compared to that, we have already seen deals worth $6 billion in 6 months in this calendar year. So on an annualized basis, we are looking at again a 5x kind of a growth, which is phenomenal. Just a point I would like to make. So while we'll discuss about the strategies later, direct lending or performing credit, globally it's called direct lending, constitutes a lion's share at around 33 odd percent of the total private credit space globally. While in Indian context, that is kind of still taking shape, and I'll talk about it more later. So the reason, while on the demand side, it is pretty well understood that, because of the collapse of banks and other financial institutions, people needed some money which private credit was willing to provide. But actually, if you look from a capital provider's perspective, what led to that growth, right? The growth was driven by basically high returns. If you look at, private credit in terms of US dollar returns has delivered around 10.8% as compared to 2%, which is the income. But even if I add capital appreciation of around 7.5%, we are still talking about 10% kind of equity return in the US context, which for a debt product which is kind of stable, predictable, and provides covenanted returns is pretty remarkable. Similarly, in the Indian context, while we don't have that much this thing, as I said, it kind of started taking shape or form after 2018. If we look at the data for the last few years, private credit as a category, which includes obviously special situation, stress asset, performing credit, and the likes of that, has given around 17-18% return, whereas equity over the last 10 years has given a return of around 13%. So private credit has delivered superior return as compared to other asset classes, which has kind of attracted a lot of capital both globally, and of late it is attracting a lot of domestic capital as well. And this high return is accompanied by a much lower volatility, which has made it a major draw for people to come to this asset class. If you look at the last few moments of crisis, starting from your global financial crisis in 2007 to 2009, COVID in 2020, and the global volatility of 2022, private credit has given a very little drawdown. In fact, in the GFC, there was still a drawdown of 8%, where as compared to equity drawdown of 46%. But in COVID, it was just minus 5% as compared to 20% drawdown in equities. And in the volatility of 2022, there was in fact no drawdown. In fact, private credit gave a positive return of 6%, whereas equities fell by 18%. So similarly, if you look at on the risk-adjusted scale, which is there on the right-hand side, private credit is, giving almost same return as equities with a much lower volatility. So I think that has attracted a lot of breed of investors to that, and that is what is made people sit and take notice. Talking about India opportunity, so India, as we are all aware, that India is one of the fastest growing, in fact, the fastest growing major economy in the world. We have left behind all other peers by a big margin. And if we aspire to be a $10 trillion economy, which we will surely will by FY36 or maybe a year or two here and there, we need a lot of private capex. The next set of growth is going to be driven by private capex. So again, if you look at consumption versus investment, the last few years of growth was driven by consumption. Whereas now, again, if you look at investment is picking up and consumption is kind of cooling down. So we are going to see a lot of capex-led growth, and capex, as you know, has a multiplier effect. So capex will also need credit to fulfill itself. So again, we have tried to capture some data. If you look at, these are comparatively long-term secular trends. These are not trends that can be change in the short term. If you look at FY12 to 21, there was a steady decline in gross fixed capital formation as percentage of GDP from around 34%. Even if you exclude COVID, if I talk of just 20, it fell down to around 29%. Whereas if you look at last 2-3 years data, it is already showing signs of increasing, and now we are already sitting at around 32 odd percent, which means that if the trend has reversed and it is kind of rising, we expect it to increase progressively, and we are expecting it to touch 34 odd percent. And mind you, this is GFCF, which has a multiplier impact, as I said. So even a 2-3% kind of a change in gross fixed capital formation will lead to a huge fillip in your GDP and your kind of numbers. We are already starting to see some green shoots, though obviously a full-fledged revival is still, I think, kind of on the anvil. But if you compare 2023, kind of average capex, and 23, I think overall capex is already up by around 19% in FY23 as compared to a average CAGR of around 13% over the period of 20 to 23. So we believe that there are already some green shoots that are visible on the horizon, and we are going to see an increasing demand for capex and consequently demand for credit to fulfill that, drive that capex. So another interesting aspect that I would like to highlight, if you look at all the major economies, and including some of the economies which are not kind of as such kind of bigger or comparable in any aspect, like Vietnam and South Korea, they also have domestic credit to private sector which is far higher as compared to India. In India, the domestic credit to private sector is around 55% of the GDP, which as compared to China, where it is 183%, and as compared to Vietnam and South Korea, which is again well above 100%. So basically, the point we are trying to make is that even if we were to kind of achieve 100% kind of a penetration in terms of domestic credit to private sector, we are looking at a $10 trillion kind of a overall credit market size, and which is going to give a fillip to all the credit classes, and obviously private credit is going to capture or going to be a big beneficiary of the same. And just to put it in perspective, right now the overall credit market size in India is around 2.5 trillion dollars. So we are talking about an exponential growth over the next 10 to 12 odd years. Again, in terms of our grounds up analysis, we have the analysis we have done indicates a visibility of around 25 to 30 lakh crore kind of investment by private sector over the next 3 to 5 years. In terms of the, again, private credit is a generic term. So in terms of what comprises private credit, what are the different kind of strategies that are available in the private credit to the investors? Let me just provide you a glimpse of the same. So obviously there are a whole lot of strategies, but I think you can broadly bucket it into these 5 buckets that we have tried. One is a performing credit. Here basically you are investing in mature companies, stable companies without any kind of a stress, which are doing pretty well. These are situation specific kind of needs which private credit comes into fill. We'll talk about this little more in detail because this is where Aditya Birla AMC is kind of focusing on. Then comes your special situation where you have a lot of companies which are in kind of either early stress, turnaround, or there are kind of impaired capital structures which kind of need to be fixed, though they are not as impaired as to be kind of going into an NPL kind of situation, but still there is something broken which needs fixing. Then you have venture debt where you are investing in early stage businesses to fund their growth. These companies are backed by venture capital, private equity. So this also as a asset class has shown decent traction in Indian context. And then you have other strategies, thematic strategies like infra focus, you have rental yield focus, you have kind of long short, you have kind of a commercial paper focus kind of a strategy, which comprises this thing. And then obviously there's a distress kind of a strategy, with which actually the private credit had an advent in at least the Indian context. These are situations where companies are in distress or default, and people try to buy a thing which was, let's say, worth 100 rupees cheap, and then try and maximize the value. So these are basically scavenging kind of situations, and the recovery could either be through NCLT or through bilateral settlement. I'll just take a moment to elaborate here why I said this is where it started, because like many other things, initially private credit in India was driven by foreign capital, offshore capital, and that obviously chases return, and they wanted higher returns, and again they have an India premium which they look for. So initial the first kind of set of investments that happened in India in private credit were led by foreign players, and obviously in their pursuit of higher returns, they started more with distress. Now though obviously you have even foreign capital which is kind of competing at the lower end of the kind of risk return spectrum as well. Okay, now let me just kind of elaborate a little more on the performing credit as a strategy, or as a what is happening in the private credit as a space. So at Aditya Birla, we believe that it's a $100 billion opportunity over the next few years. We have divided this bucket into 3 broadly. One is a growth capital. In a very nutshell, growth is something where the money is going towards asset creation. Money is going towards creation of a productive asset. So it could be your capex finance, mezzanine debt, holding company finance. Another bucket could be your strategic capital. So anything that has got to do with your capital table, whether it's an acquisition finance, facilitating any private equity exit, pre-IPO financing, bridge finance. Bridge could be towards an IPO, or bridge could be towards the monetization of a non-core asset. So all those come in strategic capital. Then you have opportunistic capital, where we are talking about sponsor finance, consolidation of promoter stake, some kind of a family settlement. In India, a lot of businesses are family driven. So maybe one faction of the family is kind of exiting, or another faction of the family is buying. Corporates exiting any high yield situation, or basically funding any cash flow mismatch. Those are examples of opportunistic finance. So obviously India being in a growth phase, we are seeing a lot more opportunities in growth capital, followed by strategic capital, and opportunistic just remains at that. To give you certain more examples, so I think there's a significant opportunities for AIFs to capitalize on the space which was vacated by banks and NBFCs in the aftermath of IL&FS crisis. So I'll just try and give you certain illustrations. So growth, as I mentioned, capex financing could be next stage of growth for an established business. He might be wanting to infuse kind of money for a new capex, new project, and he might need private credit to kind of leverage at the operating company, with money then he can use maybe as a sponsor debt, promoter contribution to set up a new plant or a new capex. Another example of growth capital could be your last mile financing. In India, a lot of projects are plagued by time and cost overrun, and typically bank financings and NBFC financing stipulate that any kind of an overrun is to be funded by promoter. So basically, what you are trying to do is that you are trying to step in and kind of bridge that gap instead of promoter bringing in equity. Obviously, you do it on a selective basis. You ring fence the structure. You kind of draw comfort. Kind of draw comfort on the promoter. You kind of draw comfort on the security package given. But what you do, you provide at the same time you provide liquidity. You provide a solution to a problem which is not being solved by the traditional providers of financing. Then could be core working capital. These could be simply a situation where a company is growing faster and the traditional channels of financing are not able to keep pace. In terms of strategic capital, acquisition finance is one very strong area where I think private credit or performing credit is having a good run, and the reason could be regulatory as well. So a lot of you may be aware that in India, banks and NBFCs are not allowed to finance for acquisition of shares per se. So this is a space where kind of private credit plays a very critical role. And again, as you grow and as lots of M&A is happening in the country, there is a lot of deal activity that happens which comes to private credit for financing. Bridge financing, as I mentioned, it could be a temporary financing till the next liquidity event. You could have a situation where a company is doing well and they decide to, let's say, exit a certain part of the business, or they decide to sell a certain unit, and that unit has a significant value, and as against that, let's say they want to borrow a fraction of the same. So we can kind of private credit can come as a bridge to that and solve a situation, and for that they will get obviously paid a little more than your traditional channels of financing. Again, a last bucket in the strategic capital, facilitating private equity exits. See, this is also extremely important. Again, as per the data that we have studied, even in the kind of buoyant kind of markets that we have been having over the last few years, less than 50% of private equity exit is provided by kind of either IPO or secondary sale in the market. Rest of the exit is provided either by some kind of strategic buyout, strategic player buying out, or the promoter buying out. So as soon as either a strategic is buying out or a promoter is buying out, basically it becomes kind of an acquisition finance. Opportunistic capital, as I said, it could be to do with a lot of family settlements have happened in India. It could be, promoter wants to acquire, kind of some minority stake. Promoter wants to kind of acquire assets. Promoter wants to delist, or it could be just a funding a temporary kind of a cash flow mismatch in businesses which are enjoying strong operating leverage. Again, if I were to kind of try and summarize, because I'm sure a lot of you would have that question on why should somebody pay you a premium, if everything is so well. So basic thesis of private credit is that we are trying to kind of defer the kind of equity dilution or infusion. So it's kind of quasi equity solution. So private credit is stepping into a stage or a situation where traditional channels of finance are not available, and actually globally as well, but more so in Indian context. If you look at, capital is a scarce commodity. Promoters still value, equity kind of a capital at upwards of 24 or, 24% kind of an IRR. So if somebody is providing a private credit, performing credit kind of a solution at 15, 16, 17% IRR, promoters are more than willing to kind of pay that, because for him, he's still saving money. And in fact, if you look at the concept of financial leverage, probably his equity IRR is going to further go up. So it's basically a win-win situation for both the borrower as well as the lender like us. In terms of our strategy, so see, this is our investment philosophy. Basically, we have a sharp focus on the 4 C's, which we are defining as character, capacity, collateral, and cash flows. So we don't, kind of compromise on the promoter quality. We do a thorough background check on the promoter, the kind of corporate governance standards that they have. Then we look at the capacity. We use certain ratios like debt to EBITDA, debt equity. So basically, we don't want to kind of get into over leverage kind of situation. The company should have basically the capacity and the capability to repay our debt. Then we lay a lot of emphasis on cash flows. Basically, see, we are not in the business of kind of possessing and selling assets. The idea is that the business should be able to service our kind of a debt along with the contracted R in the normal course of business. So cash flows is of paramount importance to us. But at the same time, we are also cognizant that, sometimes things may not go as per plan. Obviously, you are trying to kind of, forecast certain future assumptions. You make certain future assumptions and try to forecast cash flows in future. So we believe having a collateral is also significantly important. So therefore, we like hard assets, assets having realizable value, because we believe that in case things are not going as per plan, you should have something to take recourse to, which can, help you in exiting the situation along with your capital as well as interest. We want to create a very diversified portfolio. We have strict rules in terms of what is the maximum we want to do in a single borrower, single sector. We kind of avoid politically exposed sponsor, over leveraged company. While it's a sector agnostic strategy that we have at Aditya Birla, but still we like to avoid engineering, procurement, construction, contracting, trading, services, gems and jewelry. Basically, the idea is that we want to have a calibrated portfolio construction to achieve a blended IRR of around 14.5%, keeping the risk as low as possible. So just to again give you a further insight into how we want to do that. So again, in terms of sectors, as I mentioned, we like basically manufacturing, we like infrastructure, whether it's steel, chemical, roads, power, ports. Those are the sectors we like, and obviously one reason we like those sectors is that those have some kind of a recourse kind of a mechanism. In terms of product, I think I already talked about the situation in terms of growth, strategic and opportunistic. But again, some of the products are acquisition finance, loan against shares, last mile capex, bridge finance, sub debt, pre-IPO. And again, why should somebody pay a premium? I think while I already mentioned that, but the premium could simply be coming because you are providing a customized solution. So for example, the repayment is back-ended. You kind of split the IRR into some kind of a regular servicing, some kind of a back-ended or a ballooning structure. You are kind of giving a quasi equity in terms of, let's say you are giving a sub debt kind of a structure. You are financing a holding company, or simply it could be a structured transaction where you are kind of. So I'll give you a basic example of structuring. So at private credit, since it's a kind of very tailor-made solution, so we kind of try and draw comfort from various things. We look at things holistically. So sometimes if you look at things in part, it may not be serving the kind of doing justice to the situation. So that could be simply an example of how you are solving the pain point of a promoter or a company. And then obviously I mentioned there could be situations where there's a regulatory arbitrage, like in terms of financing for loan, acquisition of shares, acquisition of land, etc. So generally, we do not do transactions exceeding a door-to-door tenure of 4 years. We typically have an average maturity of around 2.5 years. That's what we kind of try and restrict to. And on top of that, I think we try and give some kind of a regular distribution to the investors. So we do believe in quarterly distribution. So 8 to 10% per annum kind of regular distribution the investors can expect. And the reason again being that it's an income product, so we want people to have that kind of a regular kind of a cash flow. So we want to distribute that. We don't keep any kind of an IRR that comes. Again, why we are guiding for low regular coupon as compared to the overall IRR is because certain structures, as I mentioned, could have back-ended, kind of redemption premium and stuff like that. Therefore, we are guiding for a distribution of around 8 to 10%, while obviously the IRRs may be significantly higher at 14, 15, 16%. In terms of our deal evaluation and investment process, we follow very rigorous kind of an approach. If there are 100 kind of companies meeting our criteria, probably only 10 end up kind of being considered for final investment. Not only we do a kind of a strict diligence in-house, we have a dedicated team which is kind of working on it. We also kind of engage and employ third-party agencies to do, let's say, kind of financial due diligence, legal due diligence, in certain cases, business due diligence, and obviously we have kind of top-notch advisors in terms of legal structuring and stuff like that. And it doesn't stop at that only. In fact, one very important point is that in our business, it is not only kind of important to make an investment after a proper diligence, but it is also how you monitor. Ours is an active strategy. Obviously in situations where you are kind of looking at 15, 16%, those kind of high IRR, you need to be very close to the situation. So we also appoint external monitoring agencies who are kind of always kind of keeping be on the lookout at any kind of early warning or any kind of deviation to the plan. And obviously investment team is always on top of that to do any course correction that may be needed. So again, I think I'll just talk a bit about Aditya Birla Capital. Why Aditya Birla? So I think we have strong domain knowledge. We are one of the largest AMCs in India. And again, if you look at Aditya Birla Capital as an overall house, we have one of the top 5 diversified NBFCs in the country. Our lending book is more than 1 lakh crore, out of which our corporate book is more than 35,000 odd crores. So this is important. I'll just again take 10 seconds to highlight why. See, again, fund teams are generally small, lean and mean teams. So it is important that we are able to leverage the ecosystem for superior origination. So again, if you look at our NBFC, they have a lot of feet on street. So we see a lot of deal flow, which I believe gives us distinct advantage as compared to other players in the market. Similarly, being a part of Aditya Birla Group, we have deep operational insights and sectoral expertise that we can assess at a very short notice. It also provides us strategic connects and M&A perspective. A lot of situations, the company may not be kind of generating that kind of a cash flows as which you want, but there may be a very valid reason. If you have that kind of a nuanced understanding as to what is happening, why it is happening, you can always take a better credit decision, what we believe. And being a part of Aditya Birla Groups helps us, kind of enables us in doing that. Similarly, we follow some of the global best practices. Sun Life is a major shareholder at our AMC, and again, our fund leadership, comes from, the brings best in class practices by being of part of the earlier, joint venture with Varde Partners. So we want to leverage this ecosystem for superior organization and domain expertise for the benefit of our investors. So just to kind of conclude, I think private credit is one of an important staple of a well diversified portfolio. It is essential. So I think the way to look at private credit is not as a separate allocation, but when you are constructing any portfolio, I'm sure debt follows makes a significant part of the allocation. Within debt, I think there is a strong case for a outsized allocation to private credit, because other than emergency kind of a corpus that one needs to assess at a very short notice, I think there is no point in earning kind of if you look at low returns, which if you adjust for inflation is hardly any real rate of kind of interest that one gets. So there is a strong case for higher private credit allocation within a debt portfolio. Obviously, as compared to equity itself, it gives a superior risk adjusted return if you look at the volatility factor, because there's hardly any volatility in this space. The investment horizon is also relatively shorter at 4 to 5 years, and again, this is without the volatility. So equities obviously has their own nuances, but you can never time the markets perfectly. Sometimes just at the time you may be wanting to exit, they may be kind of down. Whereas debt is much more stable, much more predictable. There's a regular income, as I said. Most of the, not only us, but a lot of players do focus on that, because this is an income product, and therefore it provides regular income through coupon payments. Generally, it has a multi-layered security structure. These are much better structured deals with a low loan to value ratio. So the security is pretty watertight as compared to some of the public issuances you see. Here the security value is comparatively much higher, and obviously you tend to benefit from the kind of nuanced diligence and monitoring by specialists. There's a fund manager, there's a proper investment team. So as compared to DIY kind of approach in various other products that are available, I think here it will make sense for you to go with a seasoned kind of a professional and a reputed fund house, because it is important the kind of fund manager and the AMC that you choose with, because those are the people who are going to kind of manage your money. Thanks. I think that's the kind of overview from my side. I'll now leave it open for question and answers.
Thank you, sir. I must say it was in a brief one, also a quick one. Though you have covered a lot of things in the past 20 minutes, but it was very quick, I must say. And of course, I just want to add one small disclaimer to all the participants. This is not any solitization from either from PMS Bazaar or from Aditya Birla for that matter. This is only for this education purpose. I just wanted to give a disclaimer before we could start the Q&A. So you spoke a lot about private credit, and you spoke about the macros and all. But with increasing competition of private credit space and the credit spreads have narrowed, how do you identify the opportunities and still offer alpha without taking extensive risk? Because private credit is always been compared with debt. So how do you do that?
Let me answer it in 2-3 parts. So one is actually, if you look at pricing has two factors. one is the risk-free rate and one is the risk premium. So while when we talk of the competition and stuff like that, there may be some kind of an impact in terms of risk-free rate, but in terms of risk premium, I think that's not where some people would want to kind of compromise. So I think that is one aspect. And secondly, again, if you look at the market per se, it is pretty wide. As per our own analysis, we are looking at $100 billion kind of an opportunity. So there is scope for everybody and anybody. So I don't think it's a question of how you are able to structure it, how you are able to kind of originate, whether you are able to find the right opportunity. And third is, I think it is also a question of your origination skill. If you go to a market rate, there's a chance that it will be crowded. There's always a chance that you will try and kind of undercut. But again, as I said, there will be a risk premium that will come into play sooner than later. But having said so, if you are kind of you have your strong origination, you are able to originate deals directly, I think there is enough for everyone, each and all, to kind of the cake is large enough for everyone to kind of eat.
Okay, so more like a question that just raised now. What do you think is the biggest misconceptions that investors have about the private credit in India, and how do you, as in fund manager, address it?
So conceptions, so obviously, see, one is people try and benchmark it to equity, right? I think that's one of the biggest conception, because one has to actually, when you are constructing a portfolio, you have to try and again see what is you are doing from a capital preservation perspective, what you are doing from an income perspective, and what you are doing from a capital appreciation perspective. So I think one thing is, typically when we go and speak to investors, people kind of tend to mix it with the equity perspective. See, equity is a risk money, it's a residual money. So again, while we have a point, I think the charts that I showed at the beginning of my presentation show that the returns are comparable. So I think that is one, but still, obviously, equity, people tend to look at the winners, people tend to look at the multi-baggers, and not overall. So that is obviously we tend to generalize. Whereas that you don't have those kind of fancy things, right? So that you don't have those kind of fancy things. So that is one, I think, big misconception that investors have. Secondly, in terms of risk. See, again, if I just use equity as an example, equity is the residual money. It is the layer that is belongs to the shareholders after all the debtors and creditors are paid off. So there I've seen people are very comfortable. Even of late we have seen SME IPOs, and there's been a frenzy. People go to unlisted, but when it comes to credit, people kind of perceive it as a kind of a black box, right? People perceive it as a black box. There's this fear of unknown. People kind of don't try and peel the layers and kind of look at it from a very merit perspective. Okay, what is the kind of structuring? What is the kind of strategy you are looking at? Because again, as I said, credit is a very vast kind of a term, right? What is the kind of strategy we are talking about? So, for example, like to our mind, if you look at performing credit, it's at the lowest end of the risk spectrum overall within private credit. It is so. And if you look at risk reward ratio, it's pretty favorable. So typically, you should not, I think, for a player, let's say, who's kind of looking more at stability in the portfolio, I think for him, maybe a performing credit is much more suitable as compared to a venture debt or a distress kind of a this thing. So I think, again, one needs to be open-minded. One needs to kind of go into the details, look at what kind of strategies are there, and then also try and map to the risk and return one wants. See, ultimately, if it's the pursuit of alpha. Right, it's that pursuit of alpha. If you want to generate that alpha, I think investors will also need to do their homework and try and sift through what makes sense for them, because see, strategies are out there, depending on your risk appetite. Now you need to go and decide what suits you. But I think what they need to do, what I will urge them, is that you should kind of try and read through some of those kind of product literature, product decks that are available, or consult your financial advisor. It is actually, if you look at, we have also done some kind of sensitivity analysis. People are like, people also have this kind of a fear. What if something happens? If something happens, is like, COVID happened, nobody knew. Lehman crisis happened, nobody knew, right? And similarly in equity also, you kind of keep on happening. The idea is, okay, what is something if it's going to happen? If when you trust your money to a professional fund manager, and if the portfolio is fairly well diversified, I would encourage investors should ask this question: what is the kind of sensitivity analysis you have done, right? If one investment goes wrong, how have you structured it? What is the loss that is going to be there given the default? And if you take a default probability plus you add a loss given default probability, what are the kind of returns that one is going to be left with? At least in our analysis, what we have seen that you take any comparable product that is available in the market, whether it's a bond product or it's a credit risk fund for that matter, because though obviously after 2018 that category has kind of dwindled, but if you look at the returns that are kind of available, even after you do all those sensitivities, I think there is a pretty healthy alpha that is out there to be made in the private credit category.
Okay, so we know, so you feel some investors, need to be more educated on the private credit space. More.
Yeah, I feel they need to have a more open mind, and I think once you see any subject matter takes time, like equity culture also has, kind of, in fact, it's still as compared to developed world, we are far behind even in terms of equity culture, but of late, it at least in, tier 2, tier 3 cities also, it has taken off, at least not in hinterland. So similarly, I would say credit also is in fact much more safer. So in fact, that way, I often say that, human beings are by nature rent seekers. So that way, debt fulfills some of those kind of needs much more than an equity, because for somebody who's kind of looking for a stable, predictable kind of a return and a kind of an income kind of a portfolio, which definitely a lot of investors seek out for, private credit is a very viable option, and one should evaluate it with all the earnestness.
Thank you. So let us move to the audience question. So the first question from Vijay is, what is the current infrastructure of private credit funds used to monitor all their deals and relevant covenants? Is it a built-in in-house or outsourced? Is it a scope of using AI and ML in building solutions and around monitoring and building early warning systems before the covenant breach? This is one question. It's been in two different parts.
Fair enough. So, I couldn't understand the first part, but let me try and address what I have understood. So in terms of infrastructure funds, or for that matter any fund, I think all the funds, if you have if when we are talking about a professional management, and let's assume everyone is doing their job, diligently. I think all the people monitor the deals and the related covenant. Obviously, there could be a difference in the quality. And again, in terms of in-house or outsourcing, I don't think one can outsource it ultimately as a fund manager, as a investment house. It is your primary responsibility. So outsourcing in that sense, I don't think it's the correct way. But in terms of outsourcing, so let me tell you, because I have done infra, for a large part of my life. So okay, so let's say there's a road project, and if you are talking about a lender's engineer or something, so obviously it is not possible, for the team will not go and kind of inspect, or it's not even competent. So you will have a lender's engineer, who will go and inspect and provide this report. So, but on top of that, it is the discretion of the investment lead. It is the job of the investment team or the fund manager to ask the right questions or look for the right clues. So I would say you can outsource an execution, okay, or it's like, if I have to take a very layman's example, you can put a camera, but ultimately it's you who needs to see what you want to see, what needs to be looked at, and what is important and what is critical. So in that sense, you can outsource, I would say, some kind of a physical activities, on ground activities, but otherwise monitoring has to be done in-house. Is there scope of using AI/ML? Yes, I think that's the way to go. Though those solutions, I would say, are a little more suited when you are dealing in bulk. So this is still a more niche business. But what people are doing, so I'll give you an example just for an academic interest. Like since I took an example of road, let me take there. So what people have started doing is now you use drones. You use drones, and then using AI and ML, drone is able to measure whether the kind of potholes or the kind of quality of the road and stuff like that. Similarly, in case of other also projects, also if you want to measure project progress, there are tools kind of drones. And so basically, what AI and ML is doing is it's screening through that video footage and kind of then applying algorithm. But obviously, it's a long way to go, and it's a no one size fits all kind of a solution. So I don't think that it can probably replace, but yeah, it's already supplementing the human efforts.
Got it. And let me take the next question from the same person. What is the next focus of private credit funds in India? In USA, we see more diversification, asset-backed finance like ABS backed by consumer loans or credit cards. So we have seen similar thing in one of the other AMCs who was giving a private credit fund. So want to understand the developments on, basically he wants to understand on the diversification in asset-backed finance.
So I'll answer this question slightly differently. So if you look at, I think I'll go back to what Akshara was asking in terms of misconceptions. So see, I think the thing is that when we try to experiment too much and too soon, I think that's where probably one needs to be kind of careful. Obviously, these are all beautiful structures that they all serve a particular need, right? Any product that is kind of comes to the market or kind of if there's a demand for any kind of a credit situation, there's a need, right? It's a viable need that someone needs to cater to. But I think from a again private credit as compared to how would I say equity or some other things, it's not like the flavor of the day. I think it's ultimately a very lending business, which is in fact one of the oldest things since time immemorial, even thousands years of back, even before Christ. Lending is one of the in that sense kind of money lending is one of the oldest businesses. I think one needs to stick to the basics in terms of okay, if I talk of consumer loans, credit card loans, kind of backed ABF, what is it that one wants to achieve? I would say, is your idea high return? Are you looking for granularity in your portfolio? Are you looking for some kind of a rated products? I think they can be achieved in a much more simplistic this thing. I believe that investors till the time they, kind of really graduate, they have spent some time understanding, they understand the risk and, nuances associated with the product, should basically try and keep it simple. What is it that you want? What is the risk, that you can take? And what products can serve that? The rest all I think is kind of fancy jargon, and I think again still while we talk of HNIs, you talk of UHNIs, you talk even family offices, but still these are kind of consumer loans, credit card, ABS. These are kind of very different animals, and as such, if you look at in terms of fund structures, fund machineries, these are comparatively lean and mean teams. So the idea is to manage something very efficiently, not you cannot go micro and try and look. And again, unlike equity, it's not like the flavor of the day or the trend of the day. We are not comparing whether pharma will do better or tech will do better. Here, the idea is if you want, let's say, 16% return or 18% return, what are the strategies that can give you that? Then you should look at what are the risks associated with those strategies. What is the, let's say, tenure or any other nuance that you should look at? What are the kind of fund houses, the kind of AUM that is there in those strategies, and then take a nuanced call. That's the way I would look at it.
So let me take one question from the audience now. From Kalpesh. Firstly, thank you for the webinar. And today, good news by RBI was 50 basis points cut. Would like to ask a question whether there will be any risk or hit or distress the situation on AMCs due to REIT started funding credit to real estate developers, which was previously clients of AMC or NBFCs or banks. Any insights on that? It's more into real estate, but if you want to answer.
No, I don't think so. Interest rate cut in that sense, I don't think so. It's not a question of crowding out, or it's not a question of existing deals getting repriced. So I don't think that, that impacts. So I think all these players, see, they have been existing at that way. I'll just say again, go back to one of the points I made in my presentation. Right now, we are talking about market size of less than $2.5 trillion overall, which is quite small as compared to the size of the economy that we are. So I think everybody caters to a very different segment. So if I just take an example of my own this thing, AMC, we have a large mutual fund. We are one of the largest debt houses in the country, but at the same time, we are also launching in this AIF and private credit strategies. So I don't think that one is eating into each other or one causes a stress. It's a question of different strategies, different appetites, different end uses, and different providers of those capital. So that way you will have people investing in fixed deposits, right? In India, fixed deposits is still in terms of debt one of the by far the largest kind of share of money goes towards that fixed deposit, post office. So there are different kind of players catering to different kind of needs.
With the benefit of time, let me move to the next question quickly. Do you see private capex to go up in upcoming months, and why now has that been at slowdown till now? And if you know, okay to answer, which sectors do you see capex to grow?
So I think that's thanks for asking this question. I think it's a very pertinent question, that you have asked. So I think yes, the capex is going to go up. That's what our data shows, and yeah, this also we have had a lot of conversation why not earlier and why it is going to go up now. So typically, actually, that way, if you look at now obviously some delay has happened because of COVID. Otherwise maybe it would have set in this couple of years earlier. So typically when the last kind of capex boom happened in 12, 13, 14, and those capacities kind of came in stream, so it took time for those capacities to get properly utilized. right? The consumption expenditure ultimately, as we saw, it was kind of picking up. So it was probably sometime, now post-COVID that we are seeing that those capacity utilization at a healthy level at which new capex people have started kind of committing to investing. You see a lot of, announcements. And again, typically there's a lag between, when you announce and when you start actually seeing on ground. So we believe that there's going to be a, capex in the forthcoming at least quarters, I see months wise, see, because these are long-term decision, long-term, long gestation projects. So I can't talk of month on month. These are not really fast moving economic indicators. These are completely, these come with a little bit of a lag. But yeah, over the next few quarters, we do see that there's going to be a lot of capex. In terms of sectors, again, I think this time the capex is much more widespread, much more macro. You are seeing a lot of capex in your PLI linked sectors, performance linked incentive sectors where government is kind of giving incentives. You are seeing a lot of capex in your renewable energy, roads. We are seeing some kind of a manufacturing spread out across chemicals and all. So it's by and large, I would say, spread out. It's not okay. So if somebody is asking, like maybe the last leg you used to hear maybe a lot of capex in steel or cement, capex are happening in those sectors, but it's not that they are the only capex or they are dwarfing other this thing. I think other sectors are going equally good.
And let me, wind you back to this, distressed assets part. Often there's a debate whether to restructure the, distressed asset or pursue it for a sale or for liquidation. From your vast experience in credit, what approach do you believe that offers the best long-term value creation? And what are the indicators that you look into?
Akshara, this is again, I would answer it in a little nuanced way. So one is the long-term value creation, right? So second is, when you see, debt is not a product for in a very strict sense. When you are a debt lender, at least from an investor perspective, you have to have a fine end date. Okay, so I will answer it in two parts. From a long-term perspective, obviously it is the revival of the business. See, any business what we have seen fetches maximum value when sold as a going concern. Okay, so there's no doubt about that. I'm saying there will be very few exceptions, if at all, where you would have seen higher recoveries through asset sale as compared to kind of sale of business as a going concern, or in a certain sense, if I have to forget that this change hand, basically the business as a going concern is going to give you maximum value or the revival part of it. But now when it comes to, I would say as a fund manager, if I have to look at it, I would take a slightly different approach because time has value, right? Time has money, and you need to also be kind of able to honor your commitments on the day you have, right? All these funds have a life. So there I would say, see, litigation, I think in India, given the overall legal framework, is still not a preferred way to me, choice to me. So I think the way I would look at is depending on the time that you have on hand, I think the choice is either between IBC or selling the loan. You basically sell it. See, if you have structured the kind of deal well, so like typically we do not do any deal below 2.5, 3x security cover. Then I'm saying even in a sale, it should fetch you good value. Let the promoter deal with the buyer and let that vulture fund or ARC or whoever it is deal with the promoter and let them this thing. So I'm saying as a debt lender, as long as I feel I'm getting a bang for my buck, I have no interest in maybe I'm sounding it a little bit selfish, but I have no interest in kind of waiting and watching and seeing it through the very end. My idea is to recover my money the soonest possible, and if I feel on a net present value basis I have achieved the best outcome for myself and my investors, I think one should be happy with that.
So the most question which is falling on the podium is regarding the risk involved in the credit space. And along with that, I just had one more question to add is that regarding the returns as well. So with the risk and returns will go hand in hand. But I just wanted to understand, there are other traditional bonds and publicly traded debt instruments which are offering better returns in current market situation. So I mean, why do someone want to choose a private credit at this point of time? So first question, and again, what are the risks involved in private credit? Because that's a one common question which is falling on the podium.
So on the first one, Akshara, I think, see, on a like-to-like basis, I feel private credit offers much superior return. So the returns that you're talking in the current context is also because of a lot of duration play. See, but again, duration play is not a credit play, right? Duration play, you are taking a view. You are like taking an equity view. Somebody sits on a 30-year, 40-year kind of a paper, and there's a, kind of a 50 paisa compression, 1% kind of a compression. But So that is one. So on a like-to-like basis, we believe that the private credit offers much more superior risk-adjusted return. Secondly, it offers it consistently. See, unlike a view-based thing where fine, people who got into that duration trade maybe 1 year back, already, the yields have compressed quite a bit. So that duration play more or less, it may play out a little more. I don't know how much it will play out, but now since once it becomes a consensus view, markets have already started pricing in, right? Your GSECs have already rallied by 40, 50 bips from where they were a couple of quarters back, right? So that is one part. So I believe that, if you are looking at, let's say, a 3-year, 5-year perspective and you are not looking to trade, see, this is not a trading product. Again, when people talk of a duration call, that is also from a trading mindset, because even if you were to, let's say, make that kind of a return and you were to keep holding a GSEC or a long dated, gilt paper for 3 or 5 year, you are going to earn closer to the GSEC only, right? So that is one way to look at it. Secondly, from a risk perspective, the way you look at it, I think, see, there are two broad risks. One is obviously the credit risk. So there my answer is simple. You do a sensitivity. You do, what if one investment goes wrong? What is the loss given default? What if two investment goes wrong? What is the loss given default? You make a matrix. As per our analysis, as per our calculation, it shows that, you will be still much better than any investment avenue that is available. So the credit risk can be mitigated by two or three things. From an investor's perspective, from a fund manager perspective, basically we try and diversify. We look from a portfolio diversification, sectoral diversification. We look at promoter pedigree, promoter background. So we do that, all that in our background. But from an investor perspective, what they can additionally look at is the track record of the fund manager, the AMC. That is how you can basically try and handle credit risk. Second is the liquidity risk. See, as compared to some of the other instruments, I won't say there are too many. Again, we tend to overgeneralize it, and again, we have this fear of it being, illiquid. My take is at a given price or at some price, everything in India gets traded. It is tradable. It's not that you will not get a liquidity or an exit, but yeah, as compared to any. Let's say a liquid fund as compared to a AAA or a fixed deposit, obviously this is kind of liquidity. But for that liquidity risk, I'm saying if you are, again, I mentioned you don't use your emergency corpus, you don't use your contingency corpus, but I'm sure if you have, let's say, 100 rupees debt corpus, out of that 60, 70 rupees you are not going to need in the next 3, 4 years. And anyway, these are regular income, regular distribution kind of products with low average maturity. Again, I think the operative word is average maturity. Since the average maturity is pretty low, that means you are going to have access to your money, pretty sooner than the door-to-door life of the fund. So I think there's also this misconception when people ask, okay, what is the fund life? Is it a 5-year fund, 4-year fund, 5.5-year fund? And typically, again, some of the impression that I get talking to people is that they will feel that a shorter kind of, duration may be better. Fund life may be better. In fact, I would have a strong disagreement, because that would restrict the ability of the fund manager to kind of generate that alpha. See, if everybody is going to trade, like you asked, what is happening is this JIT kind of concept, because with a lot of kind of, distributors becoming manufacturer and stuff like that. When you try and keep the, fund lives too low, that means the flexibility you have in terms of customizing a solution is very limited, and also the tail that you have to deal with any unforeseen contingency is also very kind of limited. So I don't think one should look at it that. One should ask, what is the door-to-door tenure of the deals you are going to invest in, and what is the average maturity? Basic idea is that today, if I am going to take 100 rupees from you, or let's say you are committing 100 rupees to me, and I have taken only 25 rupees, then that 25 rupees, if I am giving you a door-to-door tenure of 4 years or an average maturity of 2.5, 3 years, then that's a 2, 3 year call only you have taken, right? It has nothing to do with a fund life being 5 year, 5.5 year, right? Because the drawdown will also happen in a staggered manner, whatever over the next 2, 3, 4 quarters.
So with that, we've come to the end of the session. Of course, there are a lot of questions which was not taken on app. I request, I'll be sending these questions to you. I request your team to, get these questions answered. We have a lot of questions on the product as well as an Aditya Birla. So probably these questions can be taken off air as well. So
Sure, sure.
thank you for this wonderful session. We had, a good enlightenment for this 1 full hour. Thank you for it.
Thanks for having me on the show, Akshara, and thanks everyone for joining in. It was a pleasure talking to you all, guys. Thank you.